Hi, I'm Basil Neelambra, tutor for Audit and Assurance. In this video, I'm going to debrief section B, first case scenario for 30 marks of pre-September 2024 mock exam of Audit and Assurance. As you know, in section B, there will be 3 constructed response questions, and each question will contain a scenario which may relate to one or more requirements. And the first question scenario will be for 30 marks. The second scenario will be for 20 marks. And the third scenario will be for another 20 marks. So total section B will be 70 marks. And out of these 3 case scenarios, we can definitely predict 3 topics that every examination is being tested in Audit and Assurance. And these 3 topics together carries 49 marks out of 70 marks. So if you are very thorough in these 3 topics, you will be able to pass Audit and Assurance comfortably. And what are those 3 topics? 1, audit risk case scenario. Second one, internal control deficiency related case scenario. And the third one, substantive procedures related case scenario. In this video, I'm going to discuss the audit risk related case scenarios and how to structure the audit risk explanation and auditor's response the way examiner want to see in your answer. So without wasting our time, let's start with the first question for 30 marks. So please read the scenario, and you can see there is a scenario which say that it is related to 4 requirements. Total 30 marks will be there. As you can see, there is a question on the right-hand side. It is asking, explain inherent risk and give examples of 4 factors that increase inherent risk associated with financial statements. So it's a 5-mark question. So you have to explain inherent risk, 1 mark, and you have to give examples of 4 factors that might increase inherent risk associated with financial statement. Each factors will fetch you another 1 mark each. So what is inherent risk? Inherent risk is a risk that an assertion can be materially misstated either individually or when aggregated with other misstatements before considering internal controls. So what are the factors that increases inherent risk? 1, complexity of transactions. If the transactions are complex, or if the tax laws are complex, or if the financial reporting framework, the accounting standards are complex, you cannot control the material misstatement due to fraud or error. It's an inherent risk. Second one is subjectivity. Choice of valuation method. Choice of valuation method means you know that as per different accounting standards, assets can be valued at cost or fair value model. So which method is to be used will be decided by management. And this choice of valuation method increases inherent risk. Why is it so? Because management might be biased for a particular accounting policy or choice of valuation method. They might choose cost model, or they might choose fair value model, whichever method might help them to increase or manipulate profit. The third one is uncertainty over accounting estimates. You cannot control that. It's an inherent risk. Accounting estimates are the provisions, useful life of asset, depreciation method. All these are accounting estimates, and it will be decided by management. The last one is misstatement due to management bias or other fraud risk factors. These are the 4 factors that increases inherent risk associated with financial statement. Just simply writing these points is more than enough to fetch you 5 marks. So I have already prepared the answers. We'll be discussing the answers. Now, the next one is the most important one. Every examination questions contains this for 16 marks. Read the B part, describe 8 audit risks and explain auditor's response to each risk in planning the audit of VBuy. They're asking you to identify or describe 8 audit risk. So only 8 risks is enough. And we have to explain the auditor's response. Now, the most important thing is when you explain the auditor's response, your answer should contain overstatement or understatement, or your answer should contain the assertion that is being affected. And in case where there is control or inherent or detection risk, your answer should explain that this gave rise to inherent control or detection risk. And they're also asking you to explain auditor's response. Auditor's response means how do you respond? What audit procedures will auditor do? So in that particular point, there must be an audit procedure. There must be how this audit procedure is being done, that is which documents should the auditor verify or which ledger should the auditor verify, and most importantly, why auditor is performing this procedure should also be mentioned there. So for this, we'll have to quickly read the scenario, and while you're reading the scenario, you have to highlight the auditor's response. And the examiner's report says that you have to select the auditor's response, which you can explain properly with respect to an assertion or overstatement or understatement or the detection or control or inherent risk. And the risk that you can respond properly with respect to an audit procedure, how which ledger or document is going to be verified, and why this procedure is going to be done. The explanation, you have to select the audit risk, which you can explain and write proper auditor's response the way examiner need to see. I would advise every student to read at least 3 or 4 examiner's report, which is available in ACCA website. You can see that every examiner's report says that examiner is expecting a few things in your audit risk, particularly the assertion, overstatement, understatement, audit procedures, documentary evidence, and why these procedures are being done. So now let's quickly read the scenario. It is 1st July X5. You're an audit supervisor of Glad and Company and are planning audit of We Buy Company for the year ending 30th September X5. We Buy is an online retailer of luxury bag and watches from leading brands sourced from all over the world. The forecasted profit before tax for the year ending 30th September X5 is 23.4 million. This is normally given to calculate materiality in certain questions. Since this is the first time your firm is auditing We Buy, the planning meeting with finance director was detailed. Notes have been summarized below. So this is the first time the firm is auditing We Buy. It is a detection risk. Now, what you will have to write, this is a detection risk. And why is it a detection risk? Because Glad and Company, the auditor will not be familiar with accounting policy, account balances, and transaction of We Buy. And since auditor is auditing We Buy for the first time, We Buy's opening balances could also be materially misstated as well. Now, what will be auditor's response? The most important response is that Glad and Company, that is, auditor should spend more time to obtain understanding of We Buy Company's accounting policies, account balances, and transactions. Account balances means SOFP item, and transaction means SOPL, that is statement of P&L item, income and expense. And you can also write, the auditor should maintain professional skepticism by being alert to material misstatement due to fraud or error. The second one is most important one, where we say they have to spend more time to obtain understanding of We Buy. So 1, obtained, 1 audit risk identified. And most of the examiner's report has very clearly stated that the first paragraph should be read carefully. And particularly whenever the client is a new client, that will be stated in the first paragraph itself. And your explanation should definitely contain the word detection risk. So continuing with the next paragraph, planning meeting notes. Although company only sells through website, It has a network of 3 warehouses in different cities to reduce shipping cost. The company's management has recently introduced a director's bonus scheme to further incentivize growth in profit. Directors' bonuses were previously fixed. However, from this year, directors will be paid a bonus based on gross profit growth. So now it is based on gross profit growth. So directors' bonuses are based on growth in profit. It is an audit risk. Why is it an audit risk? Explain that. There's a risk that the directors will manipulate financial statement by overstating revenue, and income, and understating expenses, or you can also mention understating cost of sales. Now, what will be auditor's response? Glad and Company should maintain professional skepticism by being alert to material misstatement due to fraud or error. We are expecting a fraud. So auditor should maintain professional skepticism by being alert. And there is a chance for fraud. So Glad and Company should use experienced team and perform more audit procedures related to revenue and expenses to confirm that revenue is not overstated and to confirm that cost of sales or expenses is not understated. So we got that. Director's bonus is now based on gross profit. So second audit risk identified. Now moving on to the third paragraph. WeBuy's payroll processing had always been outsourced to PayM Limited, but recently the management was not satisfied with the performance of service provider and therefore cancelled the contract in early June X5. PayM had been responsible for processing and making payroll details and maintenance of employee records. 2 of WeBuy's accounts clerk were trained within a week and given task of maintenance of employee records and processing of payroll in mid-June X5. So till 30 June X5, the payroll processing was outsourced. So you can write that point which you might have learned in classes regarding payroll processing or any processing being outsourced. There's a detection risk as the auditor will not be able to obtain sufficient and appropriate audit evidence regarding internal controls of payroll and related employment costs. You can write that point. And as auditor's response, you can write the Glad & Company auditor should contact service auditor and obtain type 1 or type 2 report on internal controls of the service organization, PayM. You can write that. Apart from that, outsourced, there is one problem in this question. There is one risk. Because by mid of June X5, within a week, accounts clerk were trained in payroll. So within a week, accounts clerk are being trained to maintain payroll. So that training might not be adequate. It might not be enough. So the 2 clerks do not have sufficient experience and expertise in handling payroll. There's a risk that the payroll and related employment taxes may be under or overstated. So what should be auditor's response? Very simple. Glad & Company should perform more substantive procedures on payroll to confirm payroll and employment tax are recorded accurately. So 3 risks identified. Moving on to the 4th paragraph. The initial analytical analysis of information yielded the following result. Revenue growth is estimated to increase from 5% to 16% in a year, while gross profit margin will increase from 26 to 32. The operating margin, however, is predicted to drop from 19 to 12. So gross profit margin is going to increase from 26 to 32, Operating margin is going to decrease from 19 to 12. It's odd. Gross profit margin is expected to increase, but operating margin is expected to decrease. So there's a risk that some of the direct expenses may be wrongly classified as an assertion as operating expense, resulting in the direct expense wrongly getting classified. That means resulting in understatement of direct expense, that is cost of sales, and overstatement of operating expense. So as an auditor, what will be the auditor's response? One, review a breakdown of cost to confirm split of cost of sales and operating expense. And most importantly, compare current year cost of sales and operating expense with previous year. And if there is any significant differences, discuss that difference with the management. So how many risks we have identified? We have identified the 4 risks right now. We have to identify 4 more risks. The 5th paragraph, WeBuy's internal IT team developed its own mobile phone application for 4.8 million for selling luxury products through application. The mobile application will increase the ease with which customers book orders, and it is estimated to increase visitors on the platform. WeBuy has capitalized the entire amount, which includes 1.1 million spent on legal fee for registering application with regulator and training employees on how to use application for sales processing. The application is being tested and is expected to be rolled out to customers soon. So I hope you have identified an audit risk here. There's a misstatement committed by the management. The IT team has developed mobile application for 4.8 million, and it includes training employees on how to use the sales processing. Training cost should be expensed off. Here, training cost is wrongly classified as a capital expenditure, resulting in overvaluation of intangible asset and understatement of expense and overstatement of profit. So what should be auditor's response to this? Very simple. Glad & Company, that is the auditor, should discuss with management of WeBuy the rationale for capitalizing training expense. Glad & Company auditor should request management to remove the training fees from intangible asset and expense of it in SOPL, that is statement of P&L. Quite simple as that. The next paragraph, which is quite important, WeBuy requests customers to make a deposit of 25% of the amount upon order confirmation and remaining when goods are delivered. So there's a chance that WeBuy might recognize this deposit as revenue, not as a deferred income. It's a liability. It should be recorded as a deferred income. So there's a risk that WeBuy might have recorded this as revenue, resulting in overstatement of revenue and understatement of deferred income. And what should be the auditor's response? Very simple. Glad & Company should discuss with management what is the treatment of how revenue is recognized. If the deposit is recorded as revenue, Glad & Company should request the management to remove it and recognize it as a deferred income. Now, moving forward, there is also one more thing which is quite unique, which is very rarely asked in your audit risk. WeBuy also offers its customers the facility to return product within 10 days if they're dissatisfied with the product or think it is a fake. So goods are being returned. They have a right to return. So revenue should be recognized based on estimate. To the extent that goods will not be returned, and a refund liability should be recognized. So there's a risk that this revenue is included, resulting in overstatement of revenue and understatement of refund liability. The auditor's response is quite same. Glad & Company should discuss with management how revenue is recognized and review post-year-end returns to refund liability and discuss with management if there is a significant difference. The next one, WeBuy has recently faced increasing criticism from the local tax authorities for alleged underpayment during the year to 2.56 million, and investigation by tax authorities are ongoing. The decision is not anticipated until after year-end. However, WeBuy's tax consultant have expressed concern this amount will probably have to be paid. So, since the tax consultants is stating that this amount will have to be paid, a provision should be recorded. There's a chance that this provision might not be completely recorded, resulting in understatement of provision and understatement of expense and overstatement of profit. Always remember, with respect to provision, there will be an expense. So if provision is not recorded, means expense is also not recorded. If expense is not recorded, there will be overstatement of profit. Now, what will be auditor's response? Inspect correspondence with tax authorities to confirm the amount is 2.56 million. Or it can be obtained confirmation from tax authorities, from tax consultants about likelihood of payment, or discuss with management of WeBuy if a provision will be recognized. You can write 2 points. And the last one, WeBuy offers a deal where slightly damaged luxury bags and watches are sold at extremely discounted prices to clear inventory after the year end. This happens during the first 2 days of October after the year end. These deals are hugely successful with sales volume drastically increasing for these 2 days. So now WeBuy is offering a deal where slightly damaged bags are sold at extremely discounted price. So there's a chance that this prices is below cost of inventory. If inventory is still getting recognized at cost, there will be overvaluation of inventory. What is auditor's response to this? Review post-year-end sales invoice to confirm NRV and it is below cost, and discuss with management of WeBuy if bags and watches or inventory are written down to NRV. Those students who have attended my classes, in my class note, I have mentioned that detailed cost and NRV testing to confirm whether inventory is written off or to confirm whether inventory is not overvalued or requires a write-down. You can write that same point also in this particular answer. You will get the marks. So we have discussed the 16-mark audit risk question. I hope you have understood this. Moving forward to the next question. Describe substantive procedure auditor should perform to obtain sufficient and appropriate audit evidence in relation to research and development expense. Those students who have attended my classes, I've told you this is a very frequently asked question, and you can see that this question has been appeared in the AA pre-September 2024 mock exam, which is available in ACCA practice platform. So you can use the same words that is available in my notes. For research expense, inspect purchase invoice and supporting documents to confirm cost and agree to SOPL to confirm it is recorded in P&L. For development expenditure capitalized, inspect purchase invoice and supporting documents to confirm the cost and review if it is included in intangible asset. Now discuss with technical management and review feasibility report to confirm capitalized development expenditure are technically feasible. Review market research report to confirm BHI has the ability to sell the product and generate future economic benefit. Review disclosure to confirm it is in accordance with IAS 38 intangible asset. You can also write any other points that I have mentioned in my notes. There are at least 6 points which I have mentioned in my notes, asking you to go through that. So you can write a 1 or 2 extra points from my notes as well. So the last question of the 30-mark question, and I hope my students who have attended my classes will remember this. We have done 2 or 3 similar questions from my PowerPoint presentation on ISA 560 subsequent events. It's exactly the same type of question has been again repeated in the Debrief September 2024 mock exam, which is available in ACCA practice platform. It is now 31st December and tax authorities investigation is complete. So the year ending is 30th September X5. So after the year end, 3 months after the year end, it is on December X5, tax authorities investigation is complete. VBI has been sent a notice that the tax amount payable to tax authorities in additional taxes for 2X5, 20X5 is 2.48 million. Directors of VBI have communicated to auditors they will charge this amount in next year's financial statement as investigation was completed in the next year. No adjustment have been made to financial statement in this regard until now. Based on the information provided, explain whether financial statement require amendment. I hope you remember in my class, which we discussed PowerPoint presentation of ISA 560 subsequent event, which is also available in our Google Classroom. I've told you have the examiner is expecting 3 sentences in this kind of question where they ask you to explain financial statement require amendment. First, you have to state whether it requires amendment or adjustment. That is, you have to state whether it's an adjusting event or a non-adjusting event. And if it is an adjusting event, you have to write a particular sentence which carries normally 1 mark. Then you have to state what is the treatment. Now, I have exactly written like that. The financial statements require amendment. It is an adjusting event. Statement number 1. Why? You have to write the technical word. It provides evidence on condition existing at reporting date. Now you have to state the treatment. What is the accounting treatment? Since it's an adjusting event, a provision of 2.48 million should be recognized in X5 financial statement. It is very important to state it is X5 financial statement because you have adjusting event means you have to adjust. You have to record the provision in this particular current year itself, not in next year. So it is very important to state a provision of 2.48 million will be recognized in current year financial statement, that is 20X5 financial statement. Now D2, describe audit procedures which should now be performed in order to form a conclusion on any required amendment. So they're asking audit procedure to determine whether it's an adjusting event or not. So one is inspect the notice from the tax authorities. Why? To confirm the amount is 2.48 million because that is the amount of provision to be recorded. Review post-year-end cash payment to confirm the amount paid is 2.48 million against the provision. To confirm again, the amount is 2.48 million. Review correspondence with tax authorities to confirm investigation was going on during the year ended 30 September X5. Only that then we can say a condition existed at reporting date. You can also write one more point if you need. No adjustment have been made in financial statement in this regard until now. And directors have communicated to auditors they will charge this amount in next year financial statement. So you can write this point, discuss with management the rationale for not recording a provision and recording this in next year financial statement. You can also write, discuss with management if a provision will be recorded in SOFP. You can also write those points as well. So thank you, everyone. I hope you have understood the section B, first question, case scenario for 30 marks. All the best for your examinations.